In this episode, I do a deep dive into how premiums are designed in a highly efficient IBC policy. I also answer many of the common questions about premiums with the goal of providing you clarity in what can be a daunting subject. I'm Nate. I make sense out of money. This is Dollars and Nonsense. If you follow the herd, you will be slaughtered. All right, everybody, welcome back to the show. Once again, it's so great to have you. We are going to do a practical show today, and in fact, I am going to be sharing my screen, so if you're listening on Apple Podcasts or Spotify or something like that, you're welcome to go jump over to YouTube as well, where I'll be sharing my screen, and you can follow along there, but you should be able to get plenty out of this episode without having to go over to YouTube. With that being said, I wanted to discuss premiums today because, and we've talked about it plenty of times, but there's just so much confusion over the idea of the word premium and what it's doing inside of a policy and how it's set up and how you should see it and how you should think about it. And it's so important to, if you understand premiums correctly, then everything else falls into place. If you don't understand premiums correctly, then nothing about this banking idea, infinite banking, is going to make sense to you very much, or certainly you won't be able to achieve much with it. The goal of this episode is to provide a lot of clarity in what's going on inside of the premium mechanism of a policy, how you should think about it, and then I'm also at the end going to answer the common questions and common misconceptions that can come to the table pretty easily with premiums. And before we dive in, once again, we appreciate you so much. We love that you're here. We love doing these. Our goal is to produce the best content in the IBC world. And so if you would do us a favor, we would appreciate so much if you would leave us a review, a comment, a like, a subscribe, whatever it is that you can do to kind of help the algorithms think that we're awesome. And so that'd be our request to you if you're enjoying the content and getting a lot out of it. We are so appreciative of you just to be here to begin with. But let's go ahead and dive in. So we're going to focus on premiums today. And so the very first thing, whenever you start learning about the infinite banking concept and you're learning that, I can use life insurance for something that's not even life insurance. I can use it for this banking idea. First off, that's a whole can of worms that you'll have to go back in the podcast to learn what we're even talking about. But of course, the goal is to use dividend-paying whole life insurance policies to build a banking enterprise, a banking system that can last your entire life and hopefully can be built to last for many generations, where we think of it as getting into the banking business. And the only way to put capital into your bank is through a premium into these policies. That's the only way to take capital that lives somewhere else and move that capital into your own banking system. So your capital might be living in brokerage accounts, might be living in bank accounts, might be living in real estate, might be living in retirement programs, or whatever it is. We all have some capital and it lives someplace, and then you're working and you earn money, and hopefully you don't spend every dollar that you make. And so not only do you have capital, but you're accumulating capital over time due to your work and ability to earn an income. And this capital has to go someplace and flow in your life from place to place and in different investment opportunities that come your way, different processes. The bank often serves as the major hub for all transactions. And the whole point of this is to say we need to transition from bank reliance, relegate the banks to only be our operating expense money, and take all the rest of the capital that we're building in our lives and have it be paid in a premium to a dividend-paying whole life policy that's built to maximize cash value, and then use that policy as our new banking system. Or it could be many policies working together to solve the banking function in your life. And so with all of that being said, we should spend a little bit of time describing how do you design a proper IBC policy. If I'm going to be sending money to a policy through premium, what does that look like? And that's what I'm going to do today. So I'm going to jump onto the screen now. But every properly built, highly efficient, infinite banking policy that you are choosing to pour a lot of capital into with the goal of achieving all of life's financial objectives through the policy as the banking mechanism. The question is, what is the policy going to look like? How are you going to interact with it? And so understanding premiums is very important. So what I want to do is I'm going to draw out what I call the window analogy. So every policy that you start is going to have a window available to you to contribute money. And by a window, we mean there's going to be a top and a bottom of the window. There's going to be a maximum contribution that you can make, and there's going to be a minimum contribution that you should make. And it creates this window of available contributions. The top of the window for every policy is what's called the MEC limit. MEC, MEC limit, which I'm sure if you've been around much, you've heard us say that before. The MEC limit is at the top of the window. For any policy that you own, the most amount of money that can ever fit into that policy is what's called the MEC limit. That's the top of the window. And it's a yearly number, which means every year you're allowed to make contributions up to your MEC limit. At the bottom of the window is what's called a base premium. So at the top of the window is the MEC limit. The bottom of the window is what's called the base premium. And that's essentially what's the minimum contribution. And what fills up the window is what's known as the paid up additions rider, or the PUA rider. And these are the main things to understand when describing policy. So you have the top of the window is the MEC limit, the bottom is the base premium, and what fills up the window is this thing called a paid up additions rider. In our world, though, there's a few things to note about all of these. I'm going to dive into all of the details and what rights you have with this policy. But there's a couple things to note. First off, the MEC limit. You can build a policy with a MEC limit of anything you want, by the way. So you can have a policy with a MEC limit of $5 million. If you're listening to this and you have the ability to fund $5 million into a policy, congratulations. Things are going well for you. And you can do that. So you can build a policy with a $5 million MEC limit. You can build a policy with a $5,000 MEC limit. You can build a policy that can fit any amount of money that you want it to fit, but it has to be designed to fit that amount of money. That's what it has to do. So we have to know how much you want to be contributing at the forefront. And here's why. Because if you build, essentially there's a relationship, I guess what I would say, between the MEC limit and the base premium. So essentially they kind of the window rises and falls together. So if you wanted to have a $5 million MEC limit because you wanted to contribute $5 million every year, congratulations. But your base premium would be correspondingly also pretty high. And so of course, if a guy wants to put in 10 grand a year, there wouldn't be much of a reason. If that's what he wants to put in, there's no benefit to creating a MEC limit that's 100 grand a year. Well, he's only going to put in $10,000 a year. And in fact, it can potentially be even impossible in some instances to treat it that way. So what I'm trying to bring up here is that the MEC limit is totally up to you, and also the base premium is totally up to you, and how much you put into the PUA is totally up to you. But there are strategic reasons to set these in a certain way. So that's what I want to talk about today. So the MEC limit is up to you. The base premium is up to you. The paid up addition rider amount is up to you. One other thing to note about the paid up addition rider as well is that it is flexible, which this is going to be a key concept for the rest of this podcast. The base premium is set. It doesn't change. The MEC limit is essentially set. It doesn't change that much. There's some nuance to the MEC limit, but it's essentially set. The base premium is set. What is not set is your paid up additions rider. What this means, it's flexible, which what that means is you can contribute all towards the PUA rate. In other words, you can max out the window. You can pay 100% of what's available to you to fund in your paid up addition rider, or you can put in zero to the paid up addition rider any year you want. It is not a required piece to go in. It is a suggested piece, which I'm going to dive into here in just a minute. But understand that the paid up addition rider is not a required piece to the premium of your policy. It is flexible. Some insurance companies have less flexible paid up addition riders than others. In other words, they don't let you just put zero or all of it. You kind of have to, you either put zero or the schedule or something like that. So there is some less flexible PUAs out there, but none of them are ever required. So it is true though that it's nice to work with companies that have very flexible paid up addition riders, because that means that whenever you start a policy, you can put in the max of the MEC limit or the minimum of the base premium and anywhere in between whenever you want, and it doesn't even matter what you had thought you would do, what you scheduled out when you were building out the policy. Let's assume somebody wants to put in $50,000 of premium a year. That could be a big number to you, that could be a small number to you. It doesn't really matter. And so they're going to put in $50,000 a year, let's say, of premiums to a policy. The question is, where inside of this window does that number fit? Is that the base premium? Is that the MEC limit? Is that somewhere in between? Let me put it this way. How do you build a policy that is the most cash rich that you can get it? And the answer to that is you want to build the MEC limit to be right in line with what you desire and are likely to contribute. So what this means is that if I was going to start a $50,000 policy premium, you would want the MEC limit to be right at about 50 grand, maybe a little bit higher to give you a little bit of wiggle room to increase it a bit more. But for this episode, we'll just assume that if somebody wants to start a 50 grand policy, what that means is that he's going to be paying 50,000, and that's actually what's going to max the policy out. So if he contributes 50 grand of premium, then he has and that's what he wanted to do, then he's maxing the policy out. That means that also on the bottom end of the spectrum, the base premium of the policy is going to be way lower than the MEC limit. Maybe it's going to be somewhere around 15,000, maybe a little lower, maybe a little higher, depending on, the situation that's going on. So somewhere in that ballpark range, likely. And so what you'll see happening here is you have a MEC limit of 50,000. That's the max contribution. That's also what the person wanted to contribute. So what does that tell you? That tells you if he contributes what he wants to be contributing, he will be maxing out his policy each and every year. The base premium is only 15,000, which means that he has a paid-up addition rider premium to fill up the window of 35,000. Remember, is the PUA premium required anytime? No, it's not. It's totally flexible. But we are building the policy based on someone's desire to max fund the policy. And so in this situation, he would have a $50,000 top of the window, a $15,000 bottom of the window, and a $35,000 space to max it out. And that you do that through making contributions to your paid-up additions rider, which is the PUA rider is what acts as the cash booster of the policy. So this would be like a real-life policy design of sorts, and there can be a few nuances here and there, but there is an important difference, by the way, between what's the base premium and the paid-up additions rider. And so what we mean by that is the PUA rider is essentially the cash boosting piece of the policy. In the early years, typically year 1 and year 2, the base premium really does not build much cash value at all. All of the cash value that's available for you to use is coming from the paid-up addition rider contributions that you make. And so it's very important when you're launching a policy to try to max out the policy, or at least be able to contribute a decent amount of paid-up addition rider premium, because that's what's boosting the cash value. We're going to talk about this at the end of the show in a little bit more detail, but understand this too. While the base premium starts very slowly, in this guy's case, it's 15,000. It starts slowly. It doesn't build cash value in year 1 and 2, or at least if it does, it's very little. The base premium that starts slowly, it does build cash value, and it actually becomes a very efficient cash value building reservoir as time goes on. It just doesn't work quickly. So this is why you really do want to build policies where you are, whenever you are launching one, it's like launching a brand new business, you want to heavily capitalize each of your new banking branches. So every time you start a policy, you want to build it to where, we're trying to get a decent chunk of paid-up addition rider premium. We're trying to fill up the window. The important thing to note, though, and I'm going to talk about this once again at the end too, is a common misconception and question, is that there is no negative consequence to not max funding in a year. In other words, some people, they get thinking of the word premium. They're like, man, I got to come up with 50 grand a year. What happens if I don't come up with 50 grand every single year? Which we'll talk about in more detail. But essentially, there is no negative consequence to not funding a paid-up addition rider premium. There's no penalty or fee or cost. You're never required. All that you'll miss out on is something called opportunity cost, where, of course, if you had the money to pay the paid-up addition rider premium, then you would have more cash value in the policy, growing and earning dividends and all sorts of things. But that's, if you don't have it, no big deal. There's no negative consequence other than missed out opportunity. So with that being said, the base premium doesn't build cash value in years 1 and 2, and it all mainly comes from the paid-up additions rider. But once the policy gets moving, the base premium, by year 3, year 4, year 5, the base premium is producing just as much, if not more, cash value than any of your paid-up addition rider contributions. And so what you'll end up finding out is that when you're building on a policy, you don't even have to get to the top of the window every single year. You don't have to max out the mega limit, but you do want to fill up a good chunk of the window space each and every year as you're launching it. But once your policy is about 4 or 5 years old, and this accounts for every single policy that you have. Once a policy is 4 or 5 years old, You no longer have to even care about maxing out the policy. Of course, it's always great to put money into policies. New policies, old policies, base premiums, paid up addition riders, all of the, every time you can take capital that lives somewhere else, roll it into a policy first before it is deployed, you're putting yourself in a better position financially than if you didn't do it. So of course, we want our capital in the bank. But what I'm trying to say is once your policy is capitalized, once it has passed into year 4, year 5 of the policy life, you no longer have to be so targeted to try to max out the window to heavily capitalize the policy. It has already been properly capitalized. I'll talk about that here in just a minute as well in more detail when I get to the questions and misconceptions. I just wanted that to be known. So this is actually the structure of the policy. It's also true, there's one other topic I didn't bring up in this, of how the MEC limit and the base premium relate to each other. How does the MEC limit and the base premium relate to each other? Remember I said that to build the best policy, truly, is a policy where you are able to get close to max funding it each year. For the first 3 to 5 years, the best looking policies are ones where the MEC limit and your ability to contribute are right in line with each other. This is why, though, it doesn't make a lot of sense, per se, to build out a big, gigantic MEC limit when you actually don't have any desire to be paying that premium, because there's a relationship between the MEC limit and the base premium. So let's say this same guy is going to put in 50 grand. He says he wants to put in 50 grand, but what if he says, well, I want the MEC limit to be 100 just in case I want to put in 100,000 in any given year. So we change the MEC limit to where now the MEC limit's 100 grand, but what's that going to do to the base premium? It's also going to increase the base premium. And so maybe the base premium is now 30 grand instead of, 30, 35, 40, 25. I don't want to get too caught up in the numbers, but what I'm saying is what you'll end up seeing happen, I'm going to draw it down on the screen, is you'll have a MEC limit of 100,000, maybe a base premium in our example of 30,000, but if he only really wants to contribute 50, you'll notice that he's only getting a little bit of the window filled up. If he only contributes 50,000, then that's only contributing half of the window space, or even technically less of the window space, because the floor is not 0. So he's going to pay 30 grand a base and only 20 grand a PUA. That's going to result in a less efficient policy. Now, there are reasons you could build it this way, though. There really are reasons you could build it this way, and term insurance can solve some of this. So one more point on the relationship between the MEC and the base premium. The MEC limit, and we've done podcasts on this before, and the goal of this podcast was not to spend 30 minutes talking about the MEC limit. It was to talk about all of the pieces put together. So you have to go back to a MEC-focused podcast if you want to really see a deep dive into what the MEC limit is. But the idea, the simple idea behind the MEC limit is that it is really based on how much death benefit is purchased. So if you want to get bigger MEC limits, you have to get a bigger death benefit. And that's why the base premium, which is where the death benefit really comes from, the paid up addition rider does produce death benefit, but the base premium is the main producer of death benefit in every policy. So if you want to get a higher MEC limit, you have to increase the death benefit accordingly. And so the reality is, if you can create a higher MEC limit than you otherwise would be allowed to if you added what's called a term rider as well. So if you have a policy and you want to have, a 50 grand contribution, but you want the right to pay 100 grand in the policy per se, then you can build the policy as if it's kind of like a 50K policy, but then have a term rider attached to it that would boost the death benefit higher. But I wouldn't suggest this in every scenario, and I'm not going to dive into too much detail. But all that to say, the MEC limit is really going to be determined by the amount of death benefit in the policy. In order to get big MEC limits, you have to get big death benefits, and there is going to be some cost, of course, to a death benefit. That's where the cost of the base premium is really going, and there's no reason to have a big base premium and a big death benefit to support a big MEC limit if there's just no reason for you to be doing that in your financial situation. And the reason that's the case is because you can always open more policies. You can always open more policies. So what that means is if we go back to our $50,000 policy with a $15,000 base and a $50,000 MEC limit, and this guy comes to me in a year from now and he says, Nate, I built that $50,000 policy last year. I max funded it, and I'm max funding again this year, and I still have money left over, but I can't fit it into this. What should I do? Once again, the answer is simple. It's not a complicated answer. It's just simply, maybe it's time to open a second policy. And so it's okay to build in pieces your banking system to where you have maybe 4 or 5 policies, and you end up getting a MEC limit that's high enough across all of them to fit most of your cash flows. Normally, you build this over time. So this is how you build a proper, these are the pieces involved and the simple understandings of a proper IBC policy. Every time you start one, you're gonna create a window of premium paying ability. So if you say, I want to start another $50,000 premium policy, that's essentially what we're going to base your MEC limit off of. If you want to contribute 50 grand, then we want you to be able to contribute that in a way that maxes out the cash accumulation of that policy, which you've got to get close to the MEC limit to do so. But you have to carry with you the understanding that the paid up addition rider portion is flexible, not required. And so what's essentially being created is not a $50,000 premium liability. What's being created is a window of premium paying opportunity with a top of the line, let's say 50 grand, and a bottom of 15. And your goal as a good banker would be to try to fill up that window to launch the bank. Typically for the first 4 to 5 years, it'd be great to get 35 to 50 grand of total contributions to fill up. You don't have to max out the window every year, but you want to get close to the top as time goes on. And this is how you build out a good system of policies.
Are you tired of feeling like everyone has their hand in your pocket? At Living Wealth, we believe in challenging the status quo. After all, most of those conventional tools only seem to make someone else rich. Let us show you how to take back control by banking on yourself. Visit livingwealth.com/escapethebank. You'll receive instant access to what we call the Beginner's Course. This free, in-depth, easy-to-follow course teaches people how to create and profit from infinite banking. We not only discuss the philosophy and principles behind infinite banking, but also offer real-life examples to demonstrate how it works. Even folks experienced with infinite banking often tell us they learned a ton too. So, it's worthwhile regardless of your experience level. Stop letting banks and Wall Street dictate your financial future. Again, that's livingwealth.com/escapethebank to gain access to the free course today. Now back to Nate and Holly.
I wanted to, at this point, transition to answering some common questions and misconceptions. Some I've alluded to, but just to take specific time out in the podcast to discuss those questions. The first question, and one of the most common questions you'll see, is the question, do I have to pay premiums forever? So it's a very common question. Do I have to pay premiums forever? We've talked about it before on this show. The simple answer is no, you do not. And I can't say it enough. No, you do not. But there's a couple nuances in that question that reveal some things about people to some degree. Sometimes it's an innocent question. Sometimes it's not an innocent question. So what I mean by that is the goal, everybody who learns and dives into infinite banking and wants to do these policies, they have to get to a point where you have in your heart's desire, you want to pay into policies. That your goal in life is to use your banking system to create wealth. And the policies act as the springboard of that. And as wealth is being created, it's providing assets and cash flow that can roll back into your banking system. The banking system is the hub. The policies are the hub of your financial transactions. So you actually want to go into this excuse me, with the goal of saying, I want to pay premiums as long as I possibly can and as much as I possibly can. Because all that means is you are creating capital in the world for as long as you possibly can and as much as you possibly can. Because remember, capital is what pays premiums. Premiums are capital events. They're capital transfers, moving capital from one reservoir to another. So you have to enter it, first off, with the desire that I want to put money into my policies until the day I die. That's what you want. The question is not whether do I want to keep paying, the whether is can I? right? So at some point in time, you would say, Nate, what if something bad happens? Like, what if I lose my job? What if I decide to retire and I don't have enough cash flow coming in to pay all the premiums? If that's the question, that's what I call that's the innocent route. So the innocent route is mainly saying, well, Nate, there could be times where I won't be able to fund anything at all. Is that okay? And the answer is yes. Once a policy has been funded for about 4 to 5 years, especially if it's been max funded, heavy PUA premiums getting close to the MEC limit, it becomes self-sufficient. And we actually have a webinar that's been recorded. You can find it on livingwealth.com. You can also find it on our YouTube channel, the Living Wealth YouTube channel, where the title of the webinar is something like, Can a Policy Pay for Itself? I think that's it. It's Can a Policy Pay for Itself? And it describes the 3 ways that you can turn off the premium in some way, or you can at least have the policy support itself without you contributing out of pocket. So the premiums are not required. You do not have to pay premiums forever. And every example that most people have seen in Nelson Nash's book or in our course or in our website or wherever you've gone to find examples, it's very common for the example to show premiums stopping at some point. And we do that for a very specific purpose. But all that to say, you don't have to pay premiums forever, number one, but you should want to pay premiums forever. That's the caveat. You don't have to, you should want to. If you are in a position listening to this right now and you have policies and you're saying, I can't wait to turn off the premiums, then there's nothing wrong with the system. There's something wrong with your mentality towards the system. Like there's oftentimes some sort of mishap. Now, if you're in a tough financial situation and have to turn the premiums off, then it's important to know what options are available to you. But you should never want to build the bank and then say, I cannot wait to stop putting money into it. That just means you don't actually want to be doing this. Because if you want to do this, then you want to put money into it. But it is important to know. I don't want to short the idea that it is very important and comforting and reassuring to know that a policy will be self-sufficient after about 4 to 5 years of funding and capitalizing, that we don't need to. It doesn't require us. There's no negative consequence if we don't. So I don't have to pay premiums forever. I should want to, because the only way I stop paying premiums is if I'm no longer accumulating capital from somewhere in my life. That's the answer. So if you ever get to the point where you have to stop paying, or you don't want to pay premiums anymore, that happening must be a result of you no longer having capital to move over, which means you're stopped working and your investments aren't producing high enough cash flow to pay your lifestyle and also fund policy, which is fine. And in fact, the policies at some point in time are, for most of us, are going to be used as an income source, not an outflow source. So at some point in time, you'll use, if you have $5 million of cash value and you're 75 years old and you're no longer working, of course, you could be pulling out $250,000 a year of passive tax-free income and not put any premiums in. That's all wonderful. I'm just merely saying that what the proper motivation for premiums must be, I can't wait to fund them. It's exciting to move capital in, and I want to do that as long as I'm able to. But you do not have to pay premiums forever. The next question we get all the time, which I've alluded to, what happens if I don't max out my window? So if I start a $50,000 policy and I'm going in, I want to put $50,000 in, what happens if I only have 25 in 1 year? What happens if I only have 15 in 1 year? What happens if I only have 40 in 1 year? What happens if I don't max out the window? Nothing at all. Remember, there's no negative consequence for not contributing PUAs, other than the fact that it would have been better if you had contributed it. But once again, that's nonsense. If you don't have the money to do it, you don't have the money to do it. So there's no opportunity. You're not missing out on an opportunity. You'd be missing out on an opportunity cost if you had the money and then chose not to pay PUAs. Then you're missing out on growth that you could have had, that you had the ability to have. But if you're not really missing out on anything. There's no negative consequence. You do not have to max out the window of your policies every year. There's no requirement. It would be nice to do that, but honestly, it's only really great to do that for the first 4 to 5 years. So once your policy is 4 or 5 years old and has been max funded, you're pouring capital into it, that's where the paid-up addition rider is extremely important, is when you're funding it for the first 4 to 5 years. After you get through the first 4 or 5 years of a policy, it's no longer really that required. In fact, many people stop scheduling it as a part of their system. They'll just drop it to the base premium, and then they'll use what they used to pay to PUAs to maybe launch another branch to the bank. It's very, very common to do. And there's reasons to do that. I'm not going to dive into this podcast to discuss that. But all I have to say, after you get the policy built 4 or 5 years along, whether you put in money to the PUA or not is not really going to impact the rate of return of the policy. In other words, any money's great. So in other words, if the policy's earning 4.5% rate of return or something like that inside of the cash values, then it's going to earn that when you put PUAs in, and it's going to earn that if you don't put PUAs in. I hope that makes sense. So in other words, if you started a policy with no PUAs ever, it's going to be a relatively inefficient cash value builder. If you paid premiums into PUAs for the first 4 to 5 years, then it becomes a very efficient cash value building account, very highly profitable. And it doesn't need to be profitable. It doesn't need you to continue to put PUAs in. They're always welcome. They're always great. It becomes less and less important for you to focus so much on maxing it out or to even be concerned about maxing. You should never be concerned about maxing it out. But during the first 4 to 5 years, you should want to. You should build it around that. So that's that, So do I have to pay premiums forever? No. What happens if I don't max out the window? Not a big deal. It's perfectly fine. There is a misconception, though, that the base premium is what pays for insurance and the paid-up addition rider is what gives you cash. That's nonsense. Not true. The paid-up addition rider, of course, does give you cash value, but so does the base premium. The base premium doesn't build cash value in the first couple of years, but it becomes a very effective cash value builder every year after that, just like the paid-up addition rider. So while the base premium is a slow starter and the PUA is a fast starter, there's this weird misconception going around where the base is the cost of insurance, as if it's the expense of the policy. It is not an expense. You could buy a policy with no paid-up addition rider premium at all, and it would still be a profitable policy. It would just take longer. So you could start a policy with just paying base premium from day one and no PUAs, and it would make you money. You'd be profitable. You'd make money. It would just take longer, and it would be less efficient than if you had heavily capitalized paid-up addition rider premiums into it. So get that out of your head. The base premium is not the cost of insurance. It builds cash value just like the PUA, just doesn't do so early on. And the final one I wanted to do, the number 4, the fourth question or misconception is that there's a misconception out there that really, or at least it's a perspective that's incorrect, where you feel that you should design policies to where you can max out the premiums even in a down year for yourself. And this is where a lot of people wind up. And it's okay to start there. It's just problematic to stay there. So the idea is, well, you would say, like, let's say our $50,000 guy. He says, I want to put in 50 grand. But he actually has the capacity, based on his income and his investments and different things, to pay way more than that in premium. Let's just run through this. So he actually has way more ability to fund, and he wants to start conservatively. Wants to start very conservatively. It's okay to start conservatively. You'll notice, though, it'll be problematic to stay conservative, which I've talked about in the 4 stages of IBC commitment and many other podcasts and webinars since then, where essentially what occurs if you start small, way smaller than you should be, your MEC limit is way lower than what you have the capacity to contribute, you'll end up in the situation where you'll never use policies. You'll end up in the situation where you're saving money into policies and you're never using them because there's all this capital building up outside of the policy to begin with. And so there's oftentimes misconception breeds misconception breeds misconception. In the Bible it says the truth will set you free. You shall know the truth and the truth will set you free. It also says that my people are destroyed for a lack of knowledge. Now, I am in no way equating IBC with anything that has to do with scripture or the gospel in any way. But I am saying that if you are wonky and you're believing misconceptions, or you just are ignorant about certain things about policies, then it will produce faulty and misconceived results in your life. You have to understand what is actually the decision you're making when you get started, and what rights you have, and what the best way to build this thing is. And once you understand those things, then you can really manage it. If you come into it thinking with some misconceptions, mainly like this is a premium is a payment, it's an obligation, and I've got to keep it really low. I've got to keep not only the base premium, I got to keep the MEC limits way low so I can max it out every single year, even if I have a horrible year. When you build it with that idea, the default thing that will happen is you'll have a ton of capital to continue to accumulate in other buckets that never meet the policy at all. And so the policy will sit over here. You'll be putting money in. It'll be growing. It'll be earning interest and dividends. It'll be fine. But you'll never know when to use it. You'll never be implementing the system, the strategy, because you'll have 50 grand going into the policy, but you'll have a total of 150 grand going elsewhere every year or something. And you'll never be a true practitioner of the banking concept. You won't become your own banker with that. So there's this misconception. In fact, what I would say is if you are living out IBC and you never have to borrow from your policies, you got started and you've been going a couple years and you never had to borrow, the diagnosis is just simply that you are paying too little premium. You're just never having to use the policy. So the idea is this: you know that you are operating at a good capacity when you have to borrow. Like when you build your life to where you need to use policies occasionally. It's very important to build your life that way. So this has been fun, guys. Honestly, maybe it's been a little longer than I'd hoped to do, but this is how policies are built. These are the common questions and misconceptions that we run into dealing with policy premiums. If you get policy premiums, if you grasp them appropriately and put them in the right perspective, all of IBC will make sense, and you'll be able to build your life around IBC the way it was supposed to be done. If they don't make sense, you will build your life around something else, and you'll add a little tiny bit of IBC to it. So the premiums are the most important thing to understand. I know in a quick podcast we can't do everything, but I hope this was helpful to you. If you have any questions, feel free to email me, nate@livingwealth.com. I'm happy to answer some more complex questions. But that's it for today, everybody. This has been Dollars and Nonsense. If you follow the herd, you will be slaughtered.
Listener, one last thing before you go. Start your journey towards financial security and wealth today. Visit livingwealth.com/escape the bank. Upon completing this course, you'll have all the information that you'll need to see if infinite banking is right for you. Again, go to livingwealth.com/escape the bank.